Welcome to a new deep dive on the JAP Advisors Ind AS Clinic podcast.
Yeah, I'm really looking forward to this one, actually.
Same here. So today we are taking a deep dive into some truly fascinating source material. I mean, imagine watching a multi-million-dollar company artificially erase a financial fracture right in front of its auditors.
Right. And, legally publishing a mathematically corrupted cash flow statement.
Exactly. And thousands of shareholders are just, relying on it. And the wildest part is that it doesn't happen in the shadows.
No, not at all. It's right there in plain sight, buried in the typography of the annual report.
Yeah, and today we have the receipts on exactly how that happens. We're tearing down the engine of a real-world accounting anomaly.
Found in the wild, no less.
Right, discovered in the wild, just to explore how a seemingly tiny misclassification can, completely distort financial reality.
Because the mechanics of these errors, they're rarely intentional fraud. I mean, they're structural, systemic failures in understanding the geography of a financial statement.
Yeah.
When you map a data point to the wrong quadrant of the reporting framework, the entire valuation output it warps.
And you deal with these Ind AS frameworks every single day, so you know exactly how easily a misclassification can warp your valuation models.
Oh, absolutely. It's terrifying how easy it is.
But before we get to the anatomy of this specific error, we really need to establish the baseline parameters for today's deep dive, just so we're all, operating in the same technical environment.
Always a good idea. Set the stage.
Right. So first, we are analyzing a company whose functional currency and presentation currency is the Indian rupee. That is our foundational measuring stick today.
The rupee. Got it.
Therefore, any foreign currency is defined simply as any currency that is not the Indian rupee.
Which is, a critical distinction. Because the mechanics of translating those non-functional currencies at the reporting date, they trigger some of the exact non-cash adjustments we are going to dissect today.
Exactly. And our second parameter is the temporal boundary. We are operating within the standard Indian financial year.
Right. So the reporting period begins on the 1st of April.
Yep, 1st of April, and it ends on the 31st of March.
Perfect.
And finally, a mandatory disclaimer for you listening. The views expressed in this deep dive are the personal views of the author of our source material, and they are not binding on the audience.
Right. We really need to stress that.
Yeah, you are strongly requested to seek the help of a qualified expert before taking or, refraining from any action based on the views discussed herein. We're dissecting technical architecture here, but we are definitely not rendering individual advisory services.
A completely necessary boundary, because the application of any accounting standard is intensely facts and circumstances dependent. Every company is unique.
So let's talk about the stakes for a minute. For our audience of investors, analysts, corporate finance teams, the friction between accrual matching and raw liquidity is like a daily headache.
Oh, it's the core of the job, really.
Yeah. Right. So why should someone listening right now, anyone investing their hard-earned money in shares of a listed company, why do they need to care about the dense, highly technical wording of accounting standards?
Well, because those standards dictate the ultimate reality check of a business.
Okay, unpack that a bit.
So when you invest, you're basically buying a stream of future cash flows, right?
Right.
But the primary gauge of performance, the profit and loss statement, is built on accrual accounting. And accrual accounting is, at its heart, a theory.
A theory. Interesting.
Yeah, I mean, it's an incredibly useful theory. It matches revenues and expenses to the periods they actually occur, but it is heavily, heavily layered with estimates.
Right, like management assumptions and allocation.
Exactly. The cash flow statement is supposed to be the thing that strips away that theory and shows you the raw, undeniable liquidity, the actual cash.
A cold, hard cash.
Right. So if the rules of the cash flow statement are violated, the investor is essentially building their discounted cash flow models on a mirage. You're flying blind.
Wow. Okay, it's like reading the nutritional label on a box of cereal. If the company accidentally lists sugar under vitamins, you might think you're making a healthy choice, but you're actually getting a cavity.
That's a perfect analogy. As an investor, you absolutely need to know the label was printed correctly.
Which brings us to the source of today's deep dive. Where did we even find this specific mirage?
Well, this observation comes from the published Ind AS financial statements of a listed company.
The listed company, right.
Yeah. And it was downloaded and independently reviewed by GAAP advisors on a suo moto basis.
Suo moto, so they weren't even hired to find this.
Nope. They initiated a proactive technical stress test of public documents entirely on their own.
That Suomoto approach is just so vital because it acts as an independent quality control mechanism on the market, doesn't it?
Absolutely. It catches the structural failures that, frankly, slip right through the standard audit net.
And this specific finding, the one we're looking at today, was featured in the 216th edition of the Gap Advisor's Task Weekly newsletter.
Authored by C.A. Manish C. Iyer.
Right, the director of Gap Advisors. And it was published on LinkedIn. Just to give you listening some scale on this, over 230 editions have been published to date.
It's a massive wealth of knowledge.
It really is. So if you are on LinkedIn and you interact with financial reporting in any capacity whatsoever, you need to subscribe to this newsletter for free. It's a must-read.
Unquestionably.
Now, a quick point of order before we open the rulebook. We are analyzing a response given under the Ind AS framework today, but does this apply to our listeners who are operating under IFRS globally?
Categorically, yes.
Oh, really? No differences?
None at all. There is absolutely no difference between Ind AS and IFRS for the specific topic being discussed today.
Okay, that's great to know.
Yeah, the fundamental mechanics of cash flow preparation that we are about to explore, they apply uniformly to all entities following the IFRS framework, whether you're preparing financials in Mumbai, London, or Toronto.
Perfect.
Yep.
So let's open up the text to Ind AS 7, specifically paragraph 20.
Paragraph 20, the indirect method.
Yes, the rule governing the indirect method of determining net cash flow from operating activities. The text dictates that we start with profit or loss, and then, we adjust it.
Right, we have to strip away the non-cash items.
Yeah, and I don't want to just read this sequentially like a textbook. Let's group these adjustments to understand the illusions they're trying to strip away.
I like that framing, the illusions.
Right, so the first major illusion is the illusion of time.
That's a highly accurate way to look at it because the matching principle of accrual accounting dictates that if you buy a massive manufacturing plant, you don't recognize the entire cash outflow as an expense in year one.
Obviously not. That would tank your profits instantly.
Exactly. You capitalize the asset and you depreciate it over its useful life, say 20 years. So your net profit for any given year includes a massive deduction for depreciation.
But the actual cash, that left the building years ago.
Precisely the issue. Depreciation, depletion, and amortization, they are temporal allocations. They are non-cash items in the current reporting period.
Right. The money isn't leaving your bank account every time you record depreciation.
Exactly. So paragraph 20.A and B mandates that we add these figures back to the net profit. We are essentially unwinding the accrual clock to find the actual cash generated by the operations this year.
Okay, so we're starting with profit and adding back the depreciation to find the real cash flow. That handles the illusion of time. Let's look at the next category of adjustments dictated by the standard.
Which would be?
The illusion of currency. How does paragraph 20 deal with, unrealized foreign exchange gains and losses?
Okay, let's tie this back to our baseline rule from earlier. The functional currency is the Indian rupee.
Right.
Now, suppose a company has a massive outstanding receivable from a client in the United States, and it's denominated in U.S. dollars.
Okay, tracking.
When the reporting period ends on March 31st, the company must restate that dollar-denominated receivable into rupees using the closing exchange rate.
And let's say the rupee has weakened against the dollar. That receivable is suddenly worth more in rupee terms, right?
Exactly. The company recognizes a foreign exchange gain in the profit and loss statement.
And here's the kicker. Has the U.S. client actually paid them yet?
No. The cash hasn't materialized at all.
Right.
It is an unrealized gain living purely on paper. And because it inflated the net profit without generating a single rupee of actual cash, paragraph 20 requires us to deduct that unrealized gain from the profit.
To find the true operating cash flow.
You got it.
Okay, so then we have a third one. Let's call it the illusion of capital structure.
This is where it gets really interesting.
Yeah, the standard explicitly tells us in point C to adjust for, quote, all other items for which the cash effects are investing or financing cash flows.
Right, so we are stripping out things like finance costs and interest income.
But wait, let me push back here. If I'm an investor, the interest a company pays on its debt is a very real cash outflow.
It absolutely is.
So why are we stripping it out of the operating section? Doesn't that give us an artificially inflated view of the company's operational health? Aren't we just treating it like an EBITDA proxy?
That's a really sophisticated critique.
Yeah.
And honestly, it's a trap a lot of junior analysts fall into.
Oh, really?
Yeah, because we aren't ignoring the capital intensity or the debt burden of the business. We are merely reorganizing the geography of the statement.
Geography again. I love that term for this.
Right. Because Ind AS 7 requires cash flows to be strictly segregated into three buckets: operating, investing, and financing activities.
Okay.
Paying interest on debt is a financing activity. Earning interest on a surplus cash deposit is an investing activity. If those items were already embedded in the net profit, leaving them there would mix financing and investing cash flows into the operating cash flow bucket.
Ah, I see. So we add the finance cost back to net profit in the operating section just to neutralize it.
Exactly.
And then we report the actual cash paid for interest down below in the financing section.
Precisely. We are just moving the numbers to their correct analytical buckets,
Okay.
so investors can assess the core operations entirely independent of how the company chose to fund itself.
Okay, that makes perfect sense. So paragraph 20 is fundamentally a reconciliation bridge.
With a bridge, yes.
Like, we start on the abstract island of accrual profit, and we systematically walk across the bridge, paying tolls, adding back depreciation, subtracting unrealized gains, relocating interest to finally arrive on the solid mainland of operating cash flow.
That is exactly how it works. You have to walk the bridge.
Which brings us to the listed company in our Suomoto case study. Let's look at the anatomy of their specific error on this bridge.
Let's look at the numbers.
The source material provides the extracted figures from their cash flows from operating activities section. And for the year ended March 31st, 2020, they start their walk across the bridge with a net profit after tax of $134,445.44.
And 44 pays. Very precise.
Yeah. And the previous year, 2019, it was $267,646,000.
Okay, so that is a completely compliant starting point under the indirect method. They started on the right island.
And initially, they navigate the bridge perfectly. They add back income tax expense of $69,241.45. They add back a massive depreciation and amortization figure of $186,168.58.
Which is textbook paragraph 20.
They adjust for finance costs, neutralizing that capital structure illusion we just discussed. They even correctly add back $69,957.63 for exploratory well costs written off.
Ah, so they're in the extractive industry.
Yeah.
Recognizing a non-cash impairment.
Right. So the finance team preparing the statement, they clearly understand the complex mechanics of Ind AS 7.
They do. They are methodically stripping away the accrual illusions.
Until they introduce an illusion of their own.
And here we go.
Buried in this dense list of highly technical adjustments right between amortization of financial guarantee and liabilities no longer required written back, the reviewer found this specific line item: remeasurement of defined benefit plans.
There it is.
The company deducted $4,414.000 in 2020 and $4,528.78 in 2019. Now, to the untrained eye, just scanning a dense PDF, that looks like just another routine adjustment.
Wait, it blends right in.
But CIR stopped cold when he saw that. Why?
Because of the fundamental architecture of comprehensive income. To understand why this is a catastrophic mapping failure, we have to pull back for a second and look at Ind AS 19.
Ind AS 19, that governs employee benefits, right?
Exactly. And a defined benefit plan is, simply put, a pension promise. The company promises to pay an employee a specified amount post-retirement.
And calculating that liability decades into the future requires actuaries.
Oh, yes. Heavily relies on actuaries.
We know actuaries are plugging in life expectancy and discount rates, but how volatile are those inputs year over year? Like, how much can these remeasurements really swing a balance sheet?
The volatility is staggering, honestly, and it is entirely macro-driven.
Macro-driven.
Yeah, to calculate the present value of a pension obligation stretching decades into the future, the actuary must select a discount rate. And under Ind AS 19, that discount rate is determined by reference to market yields on government bonds at the end of the reporting period.
Okay, so if the central bank raises interest rates aggressively, government bond yields spike.
Which means the discount rate spikes. And mathematically, a higher discount rate drastically reduces the present value of the long-term pension liability.
Wait, really? So the company suddenly experiences a massive financial gain?
Yes, purely mathematically. Conversely, if bond yields collapse, the liability balloons and the company suffers a massive loss.
Oh, wow.
And none of this is driven by the company selling more widgets or operating more efficiently. It is entirely driven by external macroeconomic turbulence and demographic assumptions like mortality tables and salary escalation projections.
This brings us to the philosophical debate at the heart of modern accounting, doesn't it?
It really does.
Because if these massive macro-driven gains and losses hit the standard profit and loss statement, a perfectly stable, highly efficient manufacturing company could report a devastating net loss simply because the central bank tweaked interest rates on March 30th.
Exactly. which completely destroys the predictive value of the profit and loss statement for an investor.
Right, because you can't see the business through all the noise.
Yeah, if the P&L is flooded with actuarial noise, you can't tell if the core business is actually viable.
But, okay, let me play devil's advocate here. Isn't the creation of other comprehensive income, this OCI bucket where standard setters banish these remeasurements, isn't that just a form of financial obfuscation?
Oh, the obfuscation argument.
Yeah, because if I'm an equity investor, a ballooning pension liability is a real hit to the intrinsic value of the company. By hiding it in OCI, aren't standard setters just artificially smoothing the profit line to make executives look better and, protect their bonus structures?
That is the exact argument critics of OCI use, and it is a completely valid structural concern. Standard setters wrestled with this for a long time.
I bet they did.
Their compromise was to say, look, we will not hide the hit to equity. The balance sheet will reflect the true liability, but we will segregate the flow.
Segregate the flow.
Right. OCI acts as a quarantine zone. It captures these volatile, non-operating remeasurements, so they bypass the net profit line entirely.
Oh, I see.
But they still ultimately flow into total equity. So it's about preserving the signal-to-noise ratio in the operating profit figure while maintaining total balance sheet integrity.
And that geographic segregation is the smoking gun of our case study.
Yes, the smoking gun.
The source text explicitly points out, quote, remeasurement of defined benefit plans is recorded in other comprehensive income. Because it lives in the quarantine zone of OCI, it mathematically bypasses net profit.
Exactly. Let's look at the mechanical failure here. Think of it like an aircraft's instrument panel.
Okay, aircraft panel.
The net profit figure is your altimeter. It's measuring your altitude. The defined benefit remeasurement, living in OCI, is measuring your cabin pressure.
Right.
Both are absolutely critical metrics for the survival of the flight. But what the accountants did in this cash flow statement is they took the altimeter reading and they subtracted the cabin pressure reading to figure out their rate of climb.
Which is mathematical nonsense. You are combining two totally different units of reality.
Completely. The standard is unequivocal here. And AS7 paragraph 20 says you determine operating cash flow by adjusting profit or loss. You are unwinding the items that are currently packed inside the net profit figure.
So you add back depreciation because it was previously deducted inside the profit calculation.
Exactly.
But the remeasurement of the defined benefit plan was never packed inside the net profit to begin with.
Never. Not a single rupee of it.
The source text puts it brilliantly. Accordingly, profit after tax must not be adjusted for items reported in other comprehensive income. I mean, it's like you cannot unpack a sweater from a suitcase if the sweater was shipped in a completely different cargo container.
The suitcase analogy, yes. They arbitrarily took their starting net profit of $134,445.4 MIDV, and they subtracted $4,414 for an item that simply wasn't in that baseline number.
So how does a listed company equipped with sophisticated ERP systems like SAP or Oracle, a dedicated finance team, and a rigorous external audit, how do they actually make this mistake?
It's baffling, right?
Yeah. Is it a human manually typing the wrong number into an Excel sheet?
Almost certainly not. It is almost certainly a software mapping failure deep in the chart of accounts.
Really? Just a software glitch?
Well, a configuration glitch. Modern financial statements are not drafted manually. Every ledger code in the ERP system is mapped to a specific reporting line. What likely happened here is that the ledger account for actuarial gain-loss on defined benefit plans was correctly mapped to OCI for the statement of profit and loss.
Okay. So far, so good.
But in the separate mapping logic used to generate the cash flow statement, an implementation consultant or a financial controller accidentally checked a box that categorized this ledger code as a non-cash operating adjustment.
Oh, wow. So the software just blindly follows the logic tree.
Exactly. It's just a machine.
It grabs the starting net profit, loops through all the accounts tagged as non-cash adjustments, finds the defined benefit remeasurement, and just mathematically deducts it, completely unaware that it violates the fundamental architecture of Ind AS 7.
And because the number is relatively small, 4,400 against a profit of 134,000, it doesn't break any obvious reconciliation tolerances that would trigger an automated alert.
The balance sheet still balances.
The balance sheet still balances. The error just sits there, silently corrupting the subtotals. The source text's conclusion is definitive. Therefore, it is perceived that the company has not complied with the requirements of Ind AS 7.
Okay, let's talk about the ripple effect of that non-compliance. Let's bring this highly technical mapping failure back to the reality of the capital markets. For the investor relying on this published statement, what is the actual damage?
The damage is the distortion of resource allocation.
Elaborate on that.
Okay, the final number at the bottom of this specific section is operating profit before working capital changes. The company reported that figure as 517,843.27.
Right.
Because they incorrectly subtracted the OCI item, that figure is mathematically depressed.
Oh, they made their core cash generation look worse than it actually was.
Exactly. And think about the inverse. If interest rates had moved the other way, resulting in an actuarial loss, they would have erroneously added it back, artificially inflating their operating cash flow.
That's incredibly dangerous. If you are an equity analyst building a free cash flow yield model, your entire valuation is anchored to that operating cash flow figure.
Yes. If the anchor is compromised, your buy, hold, or sell recommendation is entirely compromised.
You might pass on a structurally sound company, or worse, allocate capital to a company whose operations are deteriorating simply because the ERP software mapped an OCI item to the wrong cash flow bucket.
It happens more than you'd think.
It is genuinely unsettling.
Yeah.
Because we rely on the audited veneer of these documents, right?
Yeah.
But the underlying plumbing can be completely crossed.
It's why face value is never enough.
If a listed company can publish a non-compliant cash flow statement, how are you, the investor, the auditor, or the chief financial officer, supposed to protect the integrity of your financial reality?
You protect it through rigorous, highly specialized independent verification. You cannot rely solely on the automated outputs of an ERP system.
Clearly.
And frankly, you cannot always rely on the standard audit process, which is often focused on materiality thresholds rather than granular structural logic. This is where the solutions provided in our source material become indispensable.
Yeah, the text provides a very clear proactive defense mechanism, and that is, get your financial statements reviewed by GAAP advisors before signing them.
A pre-publication review. It's brilliant.
If you are a CFO or a partner at an audit firm, the logistics are incredibly streamlined. You don't need to implement new software or overhaul your systems. You can literally submit your financial statements in near-to-publishing PDF format by email directly to info@gapadvisors.com.
It is essentially a structural stress test.
Right.
Before you assume the massive legal liability of signing that document, an expert eye like CA Managed CIer reviews the exact geography of the presentation, specifically for Ind AS compliance.
They catch the altimeter and cabin pressure mix-ups before the document ever hits the public domain.
Exactly. It's risk mitigation at its finest.
But this isn't just a defensive tool for corporate preparers. The source text explicitly notes that if you happen to invest in a listed company's shares, relying on face value is a massive risk.
Huge risk.
Utilizing a review of a company's financial statements for Ind AS compliance can actually help you in making a mathematically sound decision on buying, holding, or selling those shares. It's like your own private due diligence engine.
And beyond the direct review services, GAAP Advisors has built an astonishing infrastructure of knowledge that listeners can access directly to solve these exact types of technical friction.
Yes, let's look at the broader ecosystem highlighted in the text. The issue repository on our website, gapadvisors.com, currently hosts over 4,500 issues and their detailed responses on Ind AS and Indian GAAP.
Think about the scale of that. Over 4,500 issues.
Highly specific, real-world accounting anomalies, framework interpretations, and mapping failures, all rigorously documented and resolved.
For the auditors listening today, the value of that repository cannot be overstated. Consider the current regulatory environment.
Oh, it's intense.
When the National Financial Reporting Authority, the NFRA, initiates an inspection of an audit file, they are not just checking to see if the final numbers tie out. They are conducting deep forensic reviews of the auditor's judgment.
They want to see the working papers. They want to see the specific technical literature the auditor relied upon when they encountered a complex business combination or a convoluted lease modification.
Precisely. You cannot defend an audit judgment to the NFRA by saying, well, it looked immaterial, or the software generated it.
That won't fly.
No. You need documented, ironclad technical backing. So any posting can register on gapadvisors.com for free and submit their specific issues on Ind AS and Indian GAAP.
That's incredible.
You receive a detailed, framework-backed response delivered directly to the inbox of the email you registered with. And that response, that becomes a technical fortress in your audit documentation, proving exactly how you address the application of Ind AS.
It bridges the gap between the theoretical standard and the daily reality of financial reporting. And if an email response isn't enough, say you are dealing with a deeply complex restructuring or a cross-border IFRS consolidation issue, the source text notes that you can book a one-on-one consultation directly with the author.
Face-to-face problem solving.
Yeah, you can consult on your specific issues on Ind AS and IFRS from his page on topmate.io. You're getting direct access to the mind that catches the structural errors the market misses.
It is a comprehensive suite of tools designed to enforce reality.
Enforce reality, I love that. So let's summarize the journey we've taken today.
Let's recap.
We started with the theoretical architecture of Ind AS 7, specifically the indirect method outlined in paragraph 20. We established that operating cash flow is determined by unwinding the illusions of accrual accounting.
Right, the illusions of time, currency, and capital structure.
By systematically adjusting the starting net profit figure.
We established that the cash flow statement is a reconciliation bridge that must adhere to strict geographic logic.
Exactly. Then we dissected a real-world case study from a listed company. They successfully navigated most of that bridge. They properly adjusted for depreciation, taxes, and finance costs. But then they suffered a fatal mapping failure.
They adjusted their net profit by subtracting the remeasurement of defined benefit plans,
which violated the core mechanics of comprehensive income under Ind AS 19 and Ind AS 7. Because actuarial gains and losses on defined benefit plans are macro-driven, standard setters quarantine them in other comprehensive income.
Right. They bypass the net profit line entirely.
And because you cannot adjust a number for an item it never contained, the company mathematically corrupted its operating cash flow subtotals, resulting in clear non-compliance with the accounting standard.
A failure that distorts the valuation models of any investor relying on that data.
A structural fracture that proves exactly why independent suo motu reviews and pre-publication stress tests are absolutely vital for market integrity.
I couldn't agree more.
Which brings us to the end of our diagnostic deep dive for today. I want to sincerely thank the audience for their time and for joining us in the dense, mechanical reality of financial reporting.
It is always a privilege to unpack the architecture of these standards with listeners who really understand how critical they are to the functioning of capital markets.
We have a small request for you before we sign off today. If you found value in dissecting the mechanics of these standards today, we request that you follow or subscribe to the Gap Advisors Ind AS Clinic podcasts on Spotify, Amazon Music, and YouTube, whichever platform you prefer to listen to the Gap Advisors Ind AS Clinic podcasts on.
Building a community around technical excellence is how we elevate the standard of reporting across the board.
To help build that community, we strongly request that you share this podcast among your contacts, your colleagues, your corporate audit and finance teams, and particularly with students currently pursuing the CA course.
Yes, CA students. They are the ones who will be building the ERP mapping logic of tomorrow. Sharing this helps spread the critical foundational knowledge of Indian accounting standards.
The next generation of accountants really needs to understand the why, not just the what.
Absolutely.
As we close out, I want to leave you with a final thought to mull over. We've spent this entire time exploring a mathematically impossible adjustment, subtracting an OCI item from a net profit figure that never contained it.
An invisible logical leap.
Exactly. A leap that survived the software, survived the preparers, and survived the audit. So my question for you listening is this. If a glaring misplacement of that magnitude can quietly slip into a legally published document and distort the operating cash flow, what other seemingly standard adjustments resting quietly in the financial statements of the companies you invest in are secretly relying on fundamentally broken accounting logic?
That's the million-dollar question.
Keep stress testing the plumbing. Until next time.